was a difficult one for investors on the Australian share market, with the market looking like it's going to close the year down by 3%. Once again, it has been the defensive and high-yielding areas which have outperformed. Properties being the best performing sector with a rise of 20%, while the energy and the material sectors have been the worst with a loss of 18%. And one of the things that demonstrates how difficult 2014 has been for investors is the volatility index. Usually when volatility is low, it means good investment returns for investors. And when volatility is rising, it means a difficult investing environment. And that's certainly what we've seen in 2014. In 2014, volatility on the Australian market, measured by AVIX or the XVI, has surged a massive 43%. That's compared to 2013, where we actually saw volatility falling by 21%. So that higher volatility has meant a more difficult investing environment, and unfortunately we are expecting to see that volatility continue into 2015. So in terms of 2015, we are expecting to see earnings being difficult for the Australian share market, but I think it's useful to look at it in terms of different sectors, because there's going to be a vast difference in terms of earnings growth sector to sector. In fact, we expect the industrials to outperform because of strong earnings growth. We're neutral on the banks, whereas we do expect it to be difficult in the energy and the mining space because of those low commodity prices. Also keep an eye out for those big macro themes which should dominate investment returns, and there's three that I'm watching. First of all, the normalization of interest rates in the US, and that means the strength of the US currency. There's a number of ways that investors can play this theme. One of those is through stocks which do have a large amount of their operations over in the US. These are stocks like Brambles, Amcor, QBE Insurance, Macquarie Group, Computershare, that do derive a lot of their earnings from offshore. Secondly, watch quantitative easing from markets like Europe as well as Japan, and this should see these share markets outperforming. You can gain access to these type of returns on the Australian market through exchange traded products. So an example is IEU, which is the iShares product, which tracks the European share market. And thirdly, the very popular high yield trade is expected to continue because of the low interest rate environment here in Australia, and also possible falling cash rates here in Australia. So in terms of macro themes, they're the key ones to be watching. And of course, we're coming into Christmas. A lot of investors will be hoping for a Santa rally. And Santa rally usually occurs between Christmas and New Year's. In fact, since 2000, we've seen a positive performance in that period every single year except for 2010 and 2011. That means 2000, 2001, 2, 3, 4, 5, 6, 7, 8, 9, 2012, 2013 have all been positive ones in terms of this Santa rally. The average return has been 0.5%. The best return in 2008 at 3.8%, and the worst in 2011 with a negative 2% return. Now, there are a number of reasons why we might see a Santa rally, but I think one of the biggest reasons is that there are some big companies paying dividends in the month of December, especially the big banks. And ANZ, as well as NAB, Westpac, all pay the dividends in December, so hopefully that will, some of that money will find its way back to the market and help support the Australian share market. Merry Christmas from all of us at Bell Direct. We wish you all the best in 2015 and all the success in your investing and your trading portfolios.